Good evening. Thanks for tuning in to Mirror Now and welcome to another episode of Investor's Guide, where we help you understand all about saving, investing, and how to make your money work for you. And of course, you can get all your personal finance related questions directly answered by the experts. So whatever your question is, do send them in. You can email your questions to us on investorsguidemrn@gmail.com. You can call us on 022-2499-0546 or simply connect with us on Facebook or Twitter. All the details flashing on your screens. Well, we've got lots lined up today. On today's show, in fact, joining me is Feroze Azeez, Deputy CEO of Anand Rathi Wealth Management. Feroze, thank you so much for joining us once again on this episode of Investor's Guide. Well, we've got a lot of questions, and the focus of today's episode, Feroze, is going to be on mutual fund investing. And several queries have been coming in asking for a review of their portfolio, asking to know whether the funds that they have selected is fine or whether they need to change. So we'll also focus our discussions on that. But let's just start off with the first question that we've got from Meghna Shekhar, who says, my query is, how do you select an SIP and what are the parameters to consider? So, Feroze, the reason I picked this question is because it sort of encompasses what a lot of people would probably have, to ask. How does one go ahead and choose a mutual fund? What should be the parameters to really consider, Feroze?
See, I think rightly said, Avni, I think this is one question which has a commonality across viewers. If you are going to be a mutual fund investor, the first step is to choose the right one, choose the right category, and then in the category you have hundreds of them. Choosing the right one which fits your need and which will have the potential to help you meet your aspirations is the most important first step. So Ms. Shekhar, when you're choosing a fund, you need to take care of the first parameter, which is to make sure that the funds are chosen from a select few asset management companies, especially on the equity funds which invests in the stock market. You need to take within the top 10 asset management companies. After that, you need to see whether the fund has a 3-year existence at least. And if there is a 3-year pedigree of the fund, then you know that it's a well-oiled machinery. Point 2, you have to see who the fund manager is and the track record of the fund manager. People generally stop at the fund name. I think there's a man or a lady behind the fund who's helping you as a professional to manage the money. So it's important for you to know who the person is. Third is you will have to look at the fund house pedigree. Like we said, you have to stick to the top 10 asset management companies. You need to know what's the risk return of the fund. You need to also look at how long has the fund manager been with that fund. But I think the simpler way is to call Mirror Now, get those unbiased fund advisors, because this itself is a subject. So doing it completely by yourself will not be a good idea. So if there is an expert on the show, if he or she gives you a piece of advice, I think that's going to be the best mechanism, because it's going to be unbiased. I think that's a good start point. But it's important when you're choosing a fund, make sure that the first fund is not a small cap fund, not a mid-cap fund, but a large companies fund which invest in bigger companies, so that you first put your feet in the swimming pool and then probably take the plunge over a period of time.
Right, absolutely. In fact, some extremely important points there that you mentioned, Feroze. If we can just sort of, take that, break it down a little bit and talk about the importance of not, focusing all your investments in one fund house, why it's important to diversify, and, if we can just elaborate a little bit on that.
First, for the viewers' benefit, let's explain to them what's a fund house. Fund house is nothing but a company. It's also called an asset management company. It manages your money, right? Those are called fund houses. It is seen as a general tendency that most people buy 2-3 different mutual funds from the same company. But it's not a good strategy. If you're having 3 funds, it should be diversified across 3 different companies, because their styles of management will be different, their capabilities are different, their risk return strategies are different. So when you buy mutual funds, like Avni rightly pointed out, don't buy it from the same fund house. It quite a few times happens that you walk into a bank branch, the same bank has an asset management company as well, and you buy the funds only from that specific asset management company. Not a good strategy, because there are different capabilities which can help you meet different goals. You should diversify them across companies.
Right. And Feroze, the other question that is been extremely common obviously in the current market conditions. I mean, let's not talk about the last 2 days, but aside from that, we've been seeing the market's really falling quite significantly. And a lot of mutual funds perhaps which have been historical good performers have not done as well as one would have perhaps liked them to. So the other question is, how do you decide when to exit a fund? And also important to reiterate that it's all not good to get shaken up by ups and downs of the market.
I think, Avni, again, you've actually struck the nail right on the head, because what happens is, if you look at data of 10, 15, 20 years, that's no mean data. You can't ignore that. It has been seen that the markets will keep going up and down. That's the behavior of the animal you're dealing with. So you'll have to embrace that behavior. There will be different pockets. In a good market also, you will find different 6-monthly pockets where the markets will not do well. How much do you actually stay the course? How courageous you are to live through the painful short term to arrive at the long term will determine what your wealth actually transpired to be. So point one, make sure that you stay the course. Point two is that this is the behavior of equity markets. That's exactly why every expert you speak to will speak to you and insist that you invest for the long run. This is particularly the time why that statement has been made for hundreds of years, saying that you have to stay invested for the long run, because short term you will see blips and then moods turn around, and they actually, if you look at instances, 7-8 instances in the recent past, you would see that there is gloom, but there is something to look forward to after that. So stay the course. Don't be too worried of a 1-2 year negative return. That's happened numerous times in the past, and at the end people have made 12-14% if they've stayed the course. So don't pull the plug before you can reach the end.
All right, well, let's get on to the next query then. Comes in from Akash Sarkar, who says, I have an ongoing monthly SIPs of a total of 7,500 rupees. A time horizon is more than 10 years, and he's got Aditya Birla Sun Life Tax Relief 96 Fund, Canara Robeco Emerging Equity Fund, Parag Parikh Long-Term Equity Fund. Also says, I want to start an additional 2,500 monthly SIP for Reliance Large Cap Fund and 2,500 in a bank RD, to have some investments away from the markets. He says already has an emergency fund for 7 to 8 months, a term plan and a personal mediclaim of 10 lakhs. That's apart from the one that's provided by his employer. So the question is, are these fund selections valid, keeping in mind long-term goals? Well, Feroze, I must say, very well thought out financial plan, very well, has all the important checkpoints, whether it's insurance, emergency fund, personal mediclaim even, you don't see that too often. But as far as his funds are concerned, what's your advice?
As far as his funds are concerned, the first point, which is very relevant to all viewers, not just to Akash, is that don't step into asset management companies, especially on the equity side, in the 20th, 30th size of the company. You should try and narrow your money to the top 10 asset management companies, which is where the research is deeper, the number of analysts are more, there's more energy being spent and more information is being garnered. So of course there's nothing wrong with getting into a smaller asset management company, but it's always good to stick to the larger ones. Only if you've exhausted all the larger ones is when you need to go to the smaller ones. That's point one. Point two, of course, like Avni, you said that he's taken care of 3 important aspects: medical care cover and recurring deposit, which brings stability to the portfolio. Also has created an emergency fund in case of some eventuality with respect to his job and other recurring sources of income. If they get disturbed, then you have a contingency fund. So all these baby steps have been taken, which is very good. With respect to the other 2 funds which he has, the Aditya Birla Tax Relief Fund is a good fund, and there anyways your money is locked in for 3 big years, so you might not have finished that. So stay the course there. Change Parag Parikh to Mirai Asset Large Cap Fund, and the Reliance Large Cap Fund which you've chosen for yourself is a good fund, and I would definitely endorse that one.
Right. Well, Akash, hope that answers your questions. Keep going as you have been, and do take into account what Feroze has recommended. But Feroze, just a point on the tax saving fund. Again, important for viewers or investors to really understand that as far as their ATC investments are concerned, opt for these tax saving mutual funds only if it keeps in line with their long-term goals, it keeps in line with their ELSS or their tax saving requirements, and not to ad hoc opt for one of these funds.
Yes, Avni, I think the age-old saying that death and taxation are the 2 certainties in this world, and tax is also one of the only few free lunches you get in the investment world. So you will have to plan that adequately. properly. So ELSS, equity linked saving schemes, which is what it's an abbreviation to, is a very good vehicle because it invests in equity, unlike most other ELSS instruments, most other tax saving instruments which invest in debt, where they protect your money, do not grow it as much as the potential of the money in the long run is. So ELSS is a very good instrument. In ELSS, if you put your money, you get locked in for 3 years. But as per Section 80C, you get a discount on the first day itself on your tax for that particular year. And then whatever you earn and whatever you receive at the end is tax-free, apart from the gains being taxed at 10% now, plus cess because of the LTCG changing long-term capital gains. So the tax efficiency across all the time frames is available using an ELSS, and also helps you provide growth to the money, which is what in the long run is important for you to beat Mehngai or inflation, as we call it.
Absolutely, Feroze. And while we are talking about mutual funds, of course, the other important aspect is to understand how not to invest in too many funds, because again, we do get queries where people have put in small amounts of money in 10, 15 funds, and that really makes no sense. You're ending up spending more money in terms of the fund management charges, and you're probably over diversifying your portfolio.
Yes, Avni, this is again a very important tip for the viewers. Statistically, if you look at data, 7 to 8 funds is the maximum a person should invest. Because all these funds, optically you have diversified your money, but all the money is going back into Indian equity market. So you might be thinking, I've bought 20 funds, but those 20 are buying back the same thing and without knowing what the other 19 are doing. So optimal diversification, by which I mean don't spread your money so thin that it becomes inefficient. So 7 to 8 is the thumb rule. Even if you have a couple of crores of portfolio, 7 to 8 should suffice. Point 2, like Avni said, over diversification, by which you mean if you bought 10 funds, you will already have 500 stocks in your portfolio. If you have 500 stocks in your portfolio, you cannot beat the market. So whatever fee you are paying to the fund manager to beat the market will not be possible, because you have bought the entire market. Buying the entire market and beating it is counterintuitive. So it's important to make note of this, and whenever you draw up your investment strategy, put a limit to the number of funds you will ever own. And if you don't like any of them, replace it rather than add one more to the kitty.
Right. So, Feroze, any kind of thumb rule? Of course, you said 7 to 8 funds, but again, what kind of amounts are we really talking about? Because if you invest, say, 500 rupees in 7 to 8 funds, again, that perhaps won't be helpful either.
Correct. Absolutely, Avni. So thanks to bring me to the topic again. If you have up to 10,000 rupees to invest per month, I would suggest not more than 4. If you have the first 2,000 rupees to invest, for example, then you have 2 funds. So up to 10,000, 4, at best 5 funds is what you should do on a monthly recurring basis. Now, if you have large accumulated corpus, and if you're on the fag end of your career and you have a larger lump sum corpus, is what I implied, that you should buy 7 to 8 funds. But I think you can take 2 funds with 2,000, up to 4,000, you can have 3 funds, and till 10,000, 5 funds could be a good thumb rule for a beginner. And large cap fund first, then multi-cap, then mid-cap, and finally small cap if you've exhausted the first 3 categories.
All right, well, on to our next query from M. Ansari from Trivandrum, who says, I currently have the following funds in my portfolio. Do I need to make any changes? He's got ICICI Pru Blue Chip Fund, ICICI Pru Banking and Financial Services Fund, ICICI Pru Balanced Advantage Fund, again ICICI Pru Manufacturing in India Fund, and Reliance Large Cap Fund. So, Feroze, this is exactly what we were talking about, a perfect example of what perhaps not to do in terms of having so many funds from one fund house alone and having such specific, even thematic funds in your portfolio.
You're right, Avni. This is exactly what we were speaking about a couple of minutes back. So you should not have, see, out of your 4 to 5 funds, 4 of them, or maybe 80% of your money is being managed by one asset management company. Agree that it's the second largest asset management company. ICICI Pru ICICI is the second largest asset management company in the country, which is a good fund to include in your portfolio. But having 80% of your money being managed by one company is not a good idea. Not more than 25% of your money should be managed by one company if you have 4 funds. Point 2 is that the funds need a change, because, like Avni rightly pointed out, you have funds which are theme-based. Theme-based, by which you mean most of the money goes in a specific category of companies. Like if it's an auto fund, it's a manufacturing company fund, then it'll invest most of its money in manufacturing companies. It's not a good idea because that's like step 5, step 6, step 7. So first make sure that you make a core portion of your portfolio which becomes very solid, and then if you very strongly believe that you want to get into a sector which is anyways avoidable, but if you still believe, then that's after you finished your core portion. You just have one large cap fund from Reliance and one large cap fund from ICICI, which is the blue chip fund. You have 2 or 3 thematic funds, not a good idea. Avoid thematic funds, Mr. Sohail, and actually get into funds which are more diversified in nature.
Right. So, Feroze, what are the checkpoints or the list that you should keep in mind when you're deciding whether to exit a fund or not? Is there any steps to keep in mind or thumb rules that one should follow?
See, for every fund, there is a different interpretation of bad performance. But one thing which is a commonality before you exit a fund is to alarm or there should be a signal to figure out whether this needs deliberation or not. So that's called relative return, by which you mean if the fund is doing worse than the general market or its benchmark, like in the technical nomenclature, we call it a benchmark. Benchmark is like a pass mark for the fund manager. If that fund manager is not able to overtake this benchmark and is always lagging behind, so that's called negative relative return. It is not able to beat the benchmark. So that becomes a very, very important situation for you to reconsider staying in that fund. So you can check this on public domain or write back to us, and then we can tell you which specific fund you can exit. But the most important point to exit is to see whether the fund is beating its pass mark or the benchmark in the technical words.
All right, well, our next query comes in from Professor M. Sohail, who's 66, says that my wife and I wish to invest about 30 lakh rupees each and can also invest 2 lakh and 1 lakh each every month for 5 years. I'm a retired professor and my wife is a gynecologist. Could you please advise on how to plan our investments? Well, Feroze, so obviously here there is both sides. I mean, is a perfect example of lump sum investment as well as a regular SIP. So they have money at their disposal right now and obviously makes sense to invest as much as possible. How should they go about planning their investments?
One thing, Professor Saab, it's important for you to draw up a plan before you embark on this journey. Since the amounts are sizable enough, 30 lakhs each, and you have a recurring investment, it is also a good idea to hire an investment professional. If you are starting a 2,000 rupee SIP, I would not suggest that. So putting a plan in place is important. In the plan, the most important question to be asked is, what is the kind of cash flow you will need after you retire completely and you don't have a recurring income? That's one question we have to get answered before you get into the planning stage. Second thing is, what is the kind of asset allocation? How much risk appetite do you have? So if you have a 5-year plus time frame to invest, I would at least suggest 50 to 60% in equity. Looking at where the markets are, I think 50 to 60% in equity and 40% in debt could be a good mix of these two financial assets. Maybe 10% in gold could also be a good asset mix across these three assets. The large propellant to your portfolio will be this decision. Whether if you got this right, you've got 80% right. Second is you should buy funds in the equity category. I will mention a few of them: a Reliance large cap, a Mirai Asset large cap, L&T mid cap, Canara Robeco emerging equities, and Kotak Standard multi cap. Could be 4 to 5 funds which you can put for your 50% of your money, both for your wife and yourself. On the debt side, you can buy accrual funds and credit risk funds, which are well diversified. So Franklin Templeton Credit Risk Fund, ICICI Credit Risk Fund, Franklin Templeton Dynamic Accrual Fund. Could be these three funds could form a part of your debt portfolio. So with this 7 to 8 funds across both these asset classes, you can start formulating a portfolio and do a review every 1 year, irrespective of your time frames being 5 years plus.
Right. And Feroze, I mean, considering his age, which is 66, anything specific from, age, from an old age point of view, from a pension point of view, how does one, if there's any advice on that front?
I think since he is also getting a regular income today because of his monthly SIP possibility, he can continue with this asset allocation. But to when you get to retirement, where you actually want to enjoy the benefit of the accumulated corpus, you have to do a systematic withdrawal plan. There is something called SWP, Systematic Withdrawal Plan, which is the most tax efficient way of getting a regular income to supplement or completely replace your regular income which you might currently be getting. So point one, Avni, I suggest to him that he does an SWP whenever he so needs it at a point in time, because the tax efficiency there is enormous. Pension plans can be bought from the insurance companies, but I would suggest against that, because when you withdraw your money and you buy yourself an annuity, which is a pension plan, at that point in time, you will have to pay income tax on it. And since his corpuses are large enough, I would like to believe that he will be in the highest tax bracket. So that's why if he was in the lowest tax bracket, then you can use annuity schemes. Annuity schemes are nothing but which give you a regular flow as much as a pension plan would be. So SWP would be a more favorable tax efficient mechanism for the professor to lead a retired life post his earning lifetime.
All right, well, Professor, hope that answers your query and you get down to planning and investing at the earliest. But our next query comes in from Mukesh Asrani from Pune, who says, I'm working in an MNC and need help reviewing my portfolio. I'm investing 12,500 in the below funds for the last 2 years, but not getting returns. I'm looking for investments for 15 years and goal is wealth creation or wealth generation for my family. So the funds are Kotak Multi-Cap Fund, Tata Equity PE Fund, DSP BlackRock Tax Saver, HDFC Small Cap, HDFC Hybrid Equity and Tata India Consumer Fund. Well, Feroze, of course, time horizon is good, long-term time horizon, but again, similar issue as far as the funds are concerned, because a lot of very niche and thematic funds again in the portfolio.
Yes, Mr. Mr. Mukesh Asrani's portfolio definitely has several funds. And they are thematic funds, like you rightly pointed out, Avni. So point one, Mr. Ansari, point is that you will have to change a lot of your funds. One of them, which is very good, which is Kotak Standard Multi-Cap, which is managed by a fund manager called Harsh Upadhyay, who's a very, very good bottom-up stock picker. So that's one fund you should retain. The rest of them need to be exited. But the reason not being its bad performance, because bad performance is attributed to the external environment of the market condition, which has been bad over the last year and a half, especially because the smaller companies and the bigger companies have all of them fallen, except 8-10 of those very large companies who have held the ground. The rest of them have fallen. So nothing to worry about the market performance, but these schemes deserve a change because of their strategies not being something which can be conducive for a portfolio creation. So like we specified to the other viewers, I will reiterate some of the schemes which have my endorsement over the next 2-3 year perspective. Reliance Large Cap, Mirai Asset India Large Cap, Canara Robeco Emerging Equities, L&T Mid Cap, SBI Focused Equity. These 5 funds are a good replacement to your other 5, which will be contemporary, and you can live with them for the next 2-3 years without a review.
All right, and we've got time for one last question, Feroze, and this is an extremely interesting question and perhaps something that everyone should keep in mind about unrealistic expectations. But the question is from Samuel George, who says, I've made 20 lakhs and I'm now 25. I'm planning for 100 crore goal. What type of investments should I make? Well, Feroze, the reason I picked up this question is because obviously he's very 25 and somehow managed to accumulate a significant corpus already. But this goal of 100 crore, obviously at that age, you have all these expectations and all this ambition. But it's important to have a reality check. It's important to ensure your investments are balanced, are disciplined, more than, trying to go after something and probably end up losing everything in the process.
Yes, Avni, I think there's a difference between a goal and a dream.
Yes.
A dream with a plan becomes a goal. If you could plan for 100 crores, then it's a goal, right? So this is more little too ambitious. So keeping an expectation right. Why is this very important? Of course, not to demotivate you with a good aspiration, but it's important in the aspiration of something which is a stretched number. You might actually end up losing money. So creating a balance between the return and risk is critical. You're 25 today. You have 35 more years to work. If I assume 60 is when you work till. So that's an accumulating phase. So make sure you pursue consistent returns rather than high returns, because high returns always come with high risk. So consistency is more critical. Earning 14 to 15% on the long run in Indian equities is not going to be too difficult. So please plan how much can you save and what will that compound itself to at 13%. That's the fair expectation you can have across equities of Indian equities largely for the next 10-15 years. Making 13-14% in an equity mutual fund should not be an uphill task.
Right.
So plan according to that and work backwards and see what kind of investment amounts you will need on a monthly basis.
Well, Samuel, I urge you to write into us with, your specific goals, your how much can you put aside each month, where have you already invested in, we'll be happy to guide you with a proper investment plan. But hope that advice may not be exactly what you wanted to hear, but trust me, it is for your own good in the long term. On that note, Feroze, thank you so much for joining us and answering all of those questions. And for our viewers, please do keep writing in. And remember, the more details you give us about what your goals are, what your risk appetite is, what investments you already have, and how much you want to put aside, we'll be able to help you all that much more with our answers that the experts give you. But until next week, next Friday, when we come back with a brand new episode, thanks so much for watching and happy investing.